Hi, and welcome back to the Business Career College video series. In this video, we're going to continue learning about the lifetime capital gains exemption. This will be, I guess, what we'll consider our third video in the video series concerning lifetime capital gains exemption. If you haven't watched it or haven't watched it in a while, it's probably worth going back and reviewing at least the introductory video concerning the lifetime capital gains exemption. So in this video, we're going to look at crystallizing and purifying in order to use the lifetime capital gains exemption. These are not the same thing. So what crystallizing generally refers to is basically using the lifetime capital gains exemption before selling a company. And this can involve a couple of different processes. This might involve I should mention, sorry, before I get too far here, this is absolutely not something you need at an introductory level course. This is a financial planning and estate planning discussion. So if you're looking for your LLQP or whatever the case is, this is beyond what you need. And for your own purposes, if you're actually in the process of selling a business or planning to sell a business, you have to go get competent legal and tax advice. This might serve to explain some generalities, but there are so many very, very particular rules, and it's impossible to capture all of those in a little 10 or 15-minute video. Even in multiple days, it would be impossible to capture all the intricacies of this. So this is general information. You need to go seek proper legal and tax advice if you're actually looking to use this. Okay, so crystallizing generally means we're using the lifetime capital gains exemption before selling a business. This is generally part of an estate planning process. Purifying a company. So what happens here is we realize now that we're planning to sell. We have a fairly immediate plan to sell a business. And now we want to take advantage of the lifetime capital gains exemption, but we may have some issues that render us offside, and we need to bring the company back on side. Now, generally the two biggest issues that would prevent us from being able to use the lifetime capital gains exemption, the offside concerns here, would be if you had more than 50% or more passive assets in the 24 months prior to sale, or prior to trying to use the lifetime capital gains exemption, or if you had 90% or more passive assets, if you had, let me fix that, something less than 90% active assets at time of sale, or 10% or more active assets at time of sale. So basically, purifying means we're going to try and either turn passive assets into active assets, so turn passive assets into active assets, or to pull the passive assets out of the company. And there are a bunch of different ways that we can do that. The easiest thing to do generally is to pay a dividend to the shareholder, basically to take everything that's passive asset and pull it out as a dividend. However, the problem here is you may end up actually paying more tax this way than the amount of tax you save by using the lifetime capital gains exemption. So that may not be ideal. Other ways that you could do this, you could do what's called a butterfly transaction or a butterfly freeze. This is a very complex transaction in which basically we take the initial company, the old company, and we basically create two new companies And one of the new companies is going to own all the passive assets, and the other new company is going to own all the active assets. But you have to be real cautious with this butterfly freeze. There are lots of rules that can set you offside here, so you have to be careful around that. Other things that we can do is we can actually purchase active assets. So maybe we take some of the cash or shares or mutual fund units, they're sitting in a business, and we redeem those, and then we use that to go buy machinery or equipment, for example. So there are some possibilities here. A maybe more obscure possibility is to do something like implement an individual pension plan. And the individual pension plan basically then is a fairly tax efficient way, at least in the short term, to take some of those corporate passive assets and turn them into individual passive assets without a lot of immediate tax problems. So those are some of the potential ways that we can purify the business. And then we look at crystallizing the business. So crystallizing essentially means having some transaction today that would allow us to use the lifetime capital gains exemption. So some examples here might be to implement a trust, and often we would talk about a family trust here, or a sprinkling trust. And we will have a separate video concerning the family trust. Or what we might do here is we might use Section 85 rollover, and we have another video covering that. And as part of that Section 85 rollover, then you have an elected transfer price. And what you might want to do here is set your elected transfer price at the same level as any available lifetime capital gains exemption. Basically, what you're then going to do is trigger that lifetime capital gains exemption to offset the capital gain that you're deliberately creating. Other things that you can do here, you can do an offside Section 86 reorganization, which is a fairly complex tool again, but in a Section 85, you have to create a new company to make this thing work. Whereas in a Section 86, you're going to use the same company and you're going to trigger a capital gain. Here you don't get an elected transfer price. Here you're going to trigger your full capital gain. Other things you could consider here would be a transfer to a spouse, where you elect out of the spousal rollover. You have to be cautious with some of these. If you transfer this to a spouse and there's a maybe potential of divorce, that could be real ugly. But these things can all work in order to crystallize that lifetime capital gains exemption. Basically, the goal here is to achieve a very specific outcome. And the outcome would be that our business owner would have an ACB equal to the current lifetime capital gains exemption. So this person might have, if we have, let's say, this happening in 2014, this person might end up with an $800,000 ACB, which means any future transaction, we now have a much higher ACB and our tax consequences are reduced. Now, you wouldn't generally do either of these transactions with relatively small values. You would need to have at least several $100,000 of value on the table in order to make this worthwhile. The reason being, because you do need to get the competent tax and legal advice that I talked about earlier, you're probably looking at costs in the neighborhood of maybe $15,000 to $25,000 or more, depending on the value of the company that's at stake, in order to make these things happen. So if you have a direct cost of, say, $20,000, and you're only dealing with a $200,000 capital gain. Well, a $200,000 capital gain, only $100,000 is taxable. Let's say it's taxed at a rate of 45%. That's only $22,500 of taxes you would pay. Spending $20,000 in legal and accounting fees to save $22,500 in taxes, well, it might be worth it, but you can see that that's just on the cusp. So you have to be real cautious when you're implementing these strategies as to how complicated you want to be based on the outcome that you're likely to achieve. So I hope this helps with just a brief description of crystallizing and purifying the lifetime capital gains exemption. We will have later videos that go into some of this in more detail. I hope this has been helpful, and I hope you enjoy your continued studies. Thank you very kindly.